Oh shit, it is actually getting pretty scary out there when you stop and look at the real state of the world right now. I mean, think about the fact that we have 9 different countries sitting on nuclear weapons and a whole bunch of others working on something even more terrifying behind closed doors. We haven't dealt with global tension like this in our entire lives, and nobody honestly knows what is going to happen next. But over the past few years, there has really been one repeating news story that keeps popping up like a warning light whenever we look at Warren Buffett. It is the fact that Berkshire's cash position just keeps getting bigger and bigger, like a massive financial fortress protecting him from the chaos. Buffett finally gave us a little bit of insight into what he has actually been thinking about this wild stock market. Recently, he sat down for about 30 minutes with Becky Quick during the Berkshire Hathaway shareholder meeting, and he didn't hold back at all in this interview. He spoke deeply about why he has been building that legendary cash pile up to record levels of $380 billion. He touched on whether he actually plans to deploy that capital anytime soon or whether he sees a massive market crash coming in the year ahead. So in this video, I want to show you guys all the important clips you absolutely need to hear from the man himself. I am going to break down exactly what he has been saying because the nuance here is where the real money is made also very quickly. I want to give a massive shout out to everybody who came up and said hello over the course of the Berkshire weekend in Omaha. It was honestly so great to see you all in person and have those real conversations away from the glowing screens. And a massive, massive thank you to everyone who came out to the launch party for the new Money Strategy book. Big news, guys. As of today, the book is officially out in the world, which feels totally surreal for me. Check out the links in the description or the pinned comment if you want to learn the actual Warren Buffett strategy for yourself. I really appreciate all of you who have supported this journey so far because it has been a long road of research and writing. Okay, let's get back to Buffett. And the first big question, which is why on earth is he holding $380 billion worth of cash? Becky asked him straight up about the fact that there is so much cash on hand while he is still supposedly active in the market. She pointed out that he is looking around and clearly not seeing a lot of things he actually wants to own at these prices. Buffett's response was classic because he basically said if there's nothing good to do, then we simply do not do anything. He mentioned that in the 60 years he has been in this business, probably only 5 of them were actually juicy and worth a big swing. He brought up Tom Watson Sr. from IBM, who was once asked why his company was so incredibly successful. Watson said, "I am smart at spots and I stay around those spots." And Buffett says that is the whole game right there. This was a really interesting clip because it highlights his core strategy, which is something most retail investors totally ignore. He is not a trader and he is not an investor who is going to force himself to make 20 different investments every year just to stay busy. His secret has always been the discipline to wait for the right pitch. And that is exactly what he is doing this time around. He noted that there have only been 5 exceptionally juicy years in his entire multi-decade career. That means those massive life-changing opportunities do not come up very often at all. When they do not show up, he is much more inclined to keep his watch list firmly within his circle of competence and just sit on his hands. He refuses to sink money into a hot market just because he feels like his cash pile is getting a little bit too big for comfort, as Warren admits. In that clip right now is just not the ideal environment for his specific type of value investing, and that leads him to be fairly inactive while everyone else is chasing the next AI moonshot. With their life savings, when you look at the ways Buffett actually values the stock market, they are all screaming that things are way too expensive. Take the Shiller PE ratio, for example, which is something I've been talking about quite a bit recently. This is basically a massive price to earnings ratio for the S&P 500 that looks at a 10-year average. To smooth out the noise, the higher that number rises, the higher the multiple that investors are willing to pay just to own a piece of the market. In normal, healthy conditions, that number usually sits somewhere around 18 to 20, but we are far beyond that now. Well, I was talking to one of the guys I caught up with in Omaha this year, and he showed me something staggering right now. The Shiller PE is at the second highest point it has ever been in human. The only time it was higher was right before the dot-com bubble burst, and we are actually very close to passing that peak right now. Another indicator Buffett always monitors is the Wilshire to GDP ratio, which compares the total market cap to the actual economy. It basically measures how much investors are valuing companies versus how much the US economy is actually producing. Usually when this metric gets past 140%, investors start to get really worried that things are overheated. Today we are sitting at a number around 230%, which is a level we have literally never seen before. So with the market looking even more expensive than it was before the 2000 crash, Buffett just isn't finding deals. He mentioned that he understands fewer businesses as a percentage of the whole than he did 10 years ago. He is 95 years old and he is going to try and pretend he is an expert on the latest software architecture. He isn't going to try and have an edge on a whole bunch of younger people who grew up using these tech products. But as he says, you do not have to understand 1,000 companies. You just have to understand a few, like Apple. That has always been the Buffett philosophy of keeping things simple and staying in your lane. The one thing he absolutely will not do is drift outside his core competencies just to chase a 10% return. Buffett acknowledges that the AI craze we are seeing right now is well outside his own understanding. And I would argue it is actually outside most people's circle of competence, even if they want to admit. It is a very new industry with no clear long term winner, and nobody knows what the margins will look like in a decade. I am sure the tech will be valuable, but at this stage, it is really anyone's guess as to who comes out on top. That brings us back to Buffett's rule number one of investing, which is simply do not lose money if you aren't super confident in the outcome. It is perfectly okay to put it on the too hard pile and move on. But that is the polar opposite of the behavior we are seeing in the 2026 stock market right now. Rationality seems to have been left at the door in exchange for pure speculative adrenaline. In the interview, Buffett compared the modern market to a church. With a massive casino attached to the side, he said people move between the church and the casino, but lately the casino has gotten very attractive if you are buying or selling one-day options that isn't investing or even speculating. It is just gambling. He pointed out that nobody can actually explain why they are buying an option that expires in a few hours. The quantity of those short-term bets is just incredible, and we have never seen people in a more gambling mood than right now. This is so true, and the data on short-term options actually backs up exactly what Warren is seeing. Back in 2018, the volume of options with tiny expiry dates was a small fraction of the market, but fast forward to 2026, and that trend has completely reversed into something unrecognizable. Short-term options are now the primary game in town, with more volume in daily contracts than weekly or monthly ones. It is especially wild when you look at people betting on index ETFs instead of actual companies. The stock market is turning more and more into a high-stakes casino every single day, but does that mean it is destined to fail immediately? Just because there are gamblers running rampant, we have stretched valuations and a market that looks more expensive than the peak of the dot-com era. So I wanted to know if Buffett actually sees the whole thing cracking in the near future. He said the most likely time to buy things is when nobody else will even answer their phones. But he also warned that a crash is something people usually see coming ahead of time. If everyone is talking about it and thinking about it, then it probably isn't going to happen that way. It is usually something that comes totally out of the blue, like a nuclear bomb, or a political assassination. And this is probably the biggest thing that people get totally wrong about Warren Buffett. The news articles will always say Buffett is preparing for a crash because he has $380 billion in cash, but in his 84 years in the market. The one thing he has learned is that you can never actually anticipate a crash. You can identify when stocks are likely to underperform, but you can never predict the day the brick falls. Buffett says he doesn't like to tell people the end is coming because worrying about it doesn't do any good. It is good to be cognizant of the risks, but living in constant terror is a terrible way to invest. So with that said, what do we as value investors actually do at a time like this? When things look so bubbly well, there are really two things we need to remember if we want to keep investing like the GOAT. Number one is that we have to keep investing from the bottom up and stay in our circle of competence. We have to build our own unique watch list of businesses and check them for moats and management. And then of course we have to check the valuation using the 3 steps I talk about in my book. But from there is one other thing we need more than anything else right now, and that is patience. Lie Munger used to say we don't make money when we buy, and we don't make money when we sell. We make money while we wait for the right pitch to come across the plate. The difference between a mediocre investor and an exceptional one is always their temperament. Can you hold your nerve and keep your cash safe when everything else is flying into the stratosphere? And then when the markets finally do come down, can you keep your head and invest with total confidence? That is what it really comes down to. And if that sounds like the type of thing you want to master, then grab the book. The New Money Strategy is finally out in bookstores and airports, and I am so excited for you to read it. If you bought it already, please send me a picture of you with the book because I love seeing them. Tag me over on Instagram at newmoneyofficial or email me at hello@new.com. This book was 2 years of blood, sweat, and tears, and I am so happy it is finally in your hands. Thank you guys so much for the support and for watching this deep dive with me today. I really appreciate every single one of you, and I will see you in the next video. Peace. Welcome back to another video for today, and it is a semi-red day in the market. Finally, yes, a lot of AI names and semiconductor names were red today, and people are freaking out a bit. Financials were red as well, probably because the CPI report and inflation numbers came in hotter than expected. No rate cuts on the horizon, which is impacting names like SoFi and Robinhood, and the rest. Now I am not going to talk about that too much because to me those are obvious names for long-term investors. But okay, they were in a downward trend, and if you do not want to catch those names right now, that is fine. We will keep that story for another day and focus on why this is just a dip, but maybe not a dip worth buying yet. In my opinion, it is not a dip worth buying when we are looking at AI names and chip names and all of that. Why is that? Well, it is actually quite simple. If you look at the chart of the last few weeks, we have been going up and up and up for weeks in that specific sector. Without a single break, names have doubled or even more than doubled since the end of March in the semiconductor sector, more than doubled over the past month and a half, which is not a normal market move at all. And so if we have one day where it isn't green and it is down 4% or 5%, that is not a crash. Some names are down close to 10%, and I think Qualcomm was down 11% or 12% at one point. To me, this is not a buy the dip. situation because the valuation is still sky high now. Yes, Micron again. Micron on paper still looks very, very cheap, and that is fine. Some names can be undervalued while still being overextended, which is a concept people forget. You don't want to chase names at all-time highs that have gone up 50% in a couple of days. That is a recipe for disaster if the momentum shifts and the music stops suddenly. As you know, I said in the portfolio overview that I am taking profits, and I mean it. That is exactly what I did on Monday, and I am glad I did it before this red day hit. I have taken profits from Google, from Rocket Lab, from Micron, and from AMD to raise some cash. As for Nebus, they report Wednesday before the market opens, and we are going to go live for that. I did not take it's on Nebus, but I did sell covered calls to protect the downside a bit, which means as long as the stock does not end above $220 on Friday, I am keeping my shares and I am collecting that premium, which is basically free money if the stock stays flat or goes down. Now let's have a look at a couple of news stories and see what actually happened in the market. This is basically what happened on Tuesday. And you still had some green spots out there. You still had Nvidia that was green a little bit, and Apple was green a little bit too. But then if you look at names like Broadcom down 2% and AMD down 2.2%, it gets ugly. Intel was down 6.8% and Qualcomm down 11%, while SanDisk and Micron were also bleeding fine in the grand scheme of things. This is nothing compared to the run we have had. This is them taking not even a breather. It is like a quarter of a breather for these stocks because Micron is up something like 700% over the past 7 months. If you can believe that Nvidia is up God knows how many thousands of percent over the past 12 months too. And so if we are getting one of those red days here, it is not a trend to me. It is not a dip worth buying. If we are looking at the core names like CoreWeave, Vev is down 6% and Nebus is down 3.7%, while White Fiber is down 3%. Today, Apply was down 1.4% and Ion was up 2.5% after being down quite a lot the other day. Look at the semiconductor names. Most of them are red and the only green one is Nvidia. But again, is this the dip that you were waiting for, or are you just feeling FOMO? Probably not, because this basically brings us back to prices not seen since maybe Monday morning. So nothing really has changed with other names like financials and fintech names. Yes, here we are at super low prices, and that is where the real opportunity might be here. We have Robinhood still down close to 50% year to date, which is crazy. SoFi is also down quite a lot, and I think it is also around 50% year to date. Local was down 4.3%, and they didn't even report yet. But the market is already punishing them. Emerging markets in Latin America are getting smashed because interest rates are staying high. C Limited reported a good report, and the stock went up, but it is still down 50%. Since September, Mercado Libre is, in my opinion, an excellent company with growth at 49% year over year. Yet the stock today was up only 1.3% after being down double digits over the past few days. Right now, we are in a market where all the money is flowing towards semiconductor and AI names, and it has been sucked out of the software names like Shopify and Palantir. Even Palantir, which continues to accelerate revenue growth, is getting punished at $136. High-quality companies like Shopify are now under $100, which is a big level to me. Shopify, if it drops even lower, like back to the low 80s, is where I might start a position. That doesn't mean it will happen, but those are the prices I would like to see to feel safe. Now, if we go and have a look at the names that I sold, you can see the strategy clearly. I did add Lemonade and Axon to the watch list because things are getting interesting there. I did sell 45 shares of Rocket Lab for a 9.7% profit, which I am happy with. AMD was the same thing with a 9.6% profit. And Google gave me 9.1% on that trade. Micron was the big one with a 17.2% profit taken in a very short amount of time. Yes, the timing was great, but these names have been going up and up and up forever. I still have a position and I still have exposure, so if they go to the moon, I am there, but now my cash position is back to above 6%, which makes me feel much more comfortable if we do see a larger dip. Then at least now I have the cash to deploy and buy the fear, and if we don't see a dip, then I have cash to add to SoFi or Meta or Robinhood, maybe even Netflix, if it gives us a good entry point after their recent earnings. And then if we do see some smaller dips, for Google under 350, I will be there to buy. Same with AMD and same with Nebus if there is a big overreaction to the news tomorrow. If the numbers are great, but it is priced to perfection, the market might take it down. Then I will be adding more Nebus at lower prices because I raised the cash to do it. Same with Rocket Lab. I hope it comes down significantly back under $100. I don't know if that will happen, but if it does, I am ready with the cash in hand. That is the whole point of taking profit while still being exposed to the name. You still benefit from at some point very soon. The stock market is going to absolutely thank you very much for all most of you are going to lose
Yesterday,
your
I really appreciate
it might
you
be the AI bubble bursting and wiping trillions of dollars off the map. Now let's get back an oil shock from the Iran war sending prices to the moon. Because at the end of the day, a lot of people are not exposed to memory names. We are sitting in a melting pot of. They are probably not having the greatest stagnant wages and high interest rates. Which, by the way, doesn't really matter what you do in a single year. As long as you are consistent, nobody's going invested in this market with hundreds of thousands of dollars on the line across my performances mean absolutely nothing for us. If a crash happens tomorrow, I know exactly what I am doing. Look at your portfolio and ask if you own great companies, and the answer is usually yes. Did those companies report good earnings? I am Arsha T years old, and I did not get to. If it is, then you are owning great companies at cheap prices. To just have to wait. I know it is never seen a red feeling right now, watching everything else fly. I got here by graduating and announcing Arsha during a global shutdown. Driving announcing a new sedan that smelled like old fries and refusing to buy a sofa for a year. So these are the opportunities right now to build a position. Let us talk about back to the same example of crash last year at $150. Companies are throwing hundreds of billions at Nvidia last year when everyone was hating on it for AI. Building data centers that might not see a good company, but the narrative wasn't there. Mark Zuckerberg just admitted Meta is dumping up to those who accumulated are quite happy right now. With the stock near 400, and there are many other examples like Robinhood and their stock already dropped 5%. These companies are better companies today than they were back then, but the market is slow. Then you have the market doesn't like them right now because macro impacts certain multi-year highs, while global reserves hit rock bottom. Interest rates stay high. One day the headlines say you are not investing. The next day the Strait of Hormuz is closed. You are investing for years. Gasoline prices are because that is how you actually build real wealth. This is causing sticky inflation. Market, I feel that there are many names down quite a lot that are high quality. You might feel bad because they are not participating in this. But here's the thing. AI always a voice, but at one point the music will stop and the market will look at the other names you want to be in. A real crash is a Arsha percent drop position at a reasonable price. And over the last then you benefit from the ride-up while everyone else is chasing and FOMO. From the Josha then when we go up significantly, you are sitting in a luxurious position with options you can take profits. The average decline is about century life while the cash rolls in. Look, on average, it takes about a year and a half to hit the bottom over the past 2 years to recover. While the business is booming, an $80 billion company having incredible growth is something you don't see. Often the track record is very good. When the red days turn into red longer than a goldfish, human brain goes into protection 10 times in the next couple of years. You start thinking you should sell everything. But it could be a multi-bagger for the decade. It will take time, but in the meantime, the top line growth is accelerating. Like crazy, tremendous company weighted out 29 consecutive quarters of revenue growth above 30%. But it isn't T and AI names. If it were that easy to time the market and the price everyone would be a millionaire. Limited was up 13% today because they finally showed the market what they can do. You need a crystal ball that actually massively from its highs. You have to time the exit perfectly. It is growing fast. Then time the duration of the crash actually quite reasonable. And then time the entry right at the point of maximum fear, which is a broken stock right now. Nobody in the history of investing has ever done this. Bad companies do not grow revenue at 41% year over year. You have guys like Michael Burry from the Big Short. You're getting a higher premium because you were just growing faster than the rest. A guy has made 1,000 year doesn't even include. Then you have John Hussman, a guy with a PhD from Stanford, because the worst case is already baked into Meta is another one that gets zero. He became a hero. Despite being a massive player in the AI space, they are spending a lot of money on GPUs. And then they are also seeing positive returns already. Meta is still while the SP Woody, but it is a $1.5 trillion company growing at 33%. The market is trying to tell you it is a bad company, but the numbers say otherwise. The return on invested capital for Meta is still his investors' wealth. Even with the massive spending, I could go on and on with various names. Nobody knows what is going to happen next week, the next month, breakout the list goes on, but the main point is that is exactly why we are in a buy the dip mode. We are not even close. No risk names that doubled in 30 days are not on a discount. If you want the dip when people are put your money in a savings account about their watch inflation happened in March, and that is when we were buying because the prices. I have been on YouTube right now. I still think a lot of people are quite. I show you my real portfolio. The music can go on from A. I even started a brand new brokerage account stop, and it will be quite violent for the people because I put my money where my FOMO'd in at the top. Welcome back to the Graham Stephan Show, and it is one of those rare times damage from a crash. I am just going to turn on the camera and talk about exactly what is going on in housing. There is no agenda in the script. I am just going to be off the cuff on this one. You would have Yuan Wutim Wubai. What I am finding in the housing market is really interesting. But you would have had to sit through a dozen all of this double-digit inflation as real estate market collapsing drops. They erased all of their gains from the last 20 years because they built way too much new buyers. Aren't flooding into their market. Step one is having a plan that led me to find out that 1.1 million American homes are financial freedom, which means I don't care about the massive 15% in a single year, which is a huge red flag. If you don't have a goal, negative equity means you owe more on the house than what the house is actually worth. Ask yourself, it was very common back in 2008 when I started doing real estate as a young guy like a lawn in 2022. If the answer is yes, you feel fine about your monthly payment, but a buyer today has to pay 6.5%. Step two is to invest like you actually mean it. They cannot invest money you do not need for at least 5 to 10 years. Sellers are stuck. Pay off your high interest credit cards first commission and build a cash cushion that lets you sleep. They can get the amount they cannot lose money, so their equity is totally wiped out. Only the California has an average of $25,000 while the people who hold on get the rewards. Right now, Nevada is at low-cost index funds, and Arizona is at 24,000, while Texas because it spreads my risk across the best. Wyoming is the only one crushing it with $23,000. I don't have to worry if one company goes bust because I own the whole index. If people need to sell, they are going to have to take a massive loss, or they are going to have to foreclose, which we are starting to see more of. Changing your strategy every time the news changes is total madness. Payments or have to bring cash to close most Americans. You had now think it is a bad time to buy a house. Stop trying to time the market. Ignore the noise. Young adults and focus on what it is a bad time to buy because they are priced out. The housing market, the Fed's interest rates, running out of buyers, and the war in Iran. According to the latest data, there are 46% more. The only things you control are the quality of the assets you buy and how long you stay in the game. There were 36% more buyers. I guarantee you that a year from now we will be talking about a completely different crisis. Rose a bit, but that was likely human nature will always find something to be afraid of. My job is to stay calm. My new home fell over $21,000 in March alone. When you adjust for inflation, home prices are at their lowest level since 2014. Every single income needed to buy a typical home has increased. If you want to see exactly how I am building this brand new portfolio in real time, make $93,000 a year just to finance a basic property. I am not here. The market is dominated by baby boomers who have the assets and the cash to play. Younger generations are getting reamed. It is not built with get-rich quick schemes, but in places like Las Vegas, I see an influx of buyers coming out of the woodwork. Rattling buyers are coming from the stock market where they have made massive gains when everyone else is running their Nvidia and AI portfolios. If you are ready to stop being a victim of the RSL news cycle, closing in cash, start acting like a professional. Hit that. The market is totally bifurcated. I don't care about your diamond hands and the average worker. I care about your net worth at its second most expensive level and build something that lasts. Years of data. The PE ratio is at 38, and only the dot. Compeak was higher than where we are now. Why are you still listening? This is the new normal because of the digital economy. Every time the market drops our percent, but the Buffett indicator scrollers come out of the woodwork to tell you the end is nigh. Suggests we are in a bubble. The housing market is currently a playground for people with AI chip company money. They are flooding the market with cash and bidding up properties to dumb level. Listening to the average person is unfortunately screwed. I almost didn't start investing because I was convinced a crash. Let me know what you think down in the comments. Imagine if happening in your city. I wouldn't have just chatting with you guys like this. Rather than doing reaction videos all day, hit the like button and subscribe if you want. More of these off the cuff deep dives is always higher than the cost of a temporary dip. In this crazy market,